All right, let's get right into it. We're going to dive deep into the financial architecture that's used for, well, minimizing taxes and protecting your assets. We're going to break down the exact strategies you can use to build a system that doesn't just grow your wealth, but actually protects it every single step of the way.
You know, it's a frustration so many people feel, right? It feels like the more you earn, the more you're just working for the government. And that's because of our progressive tax system. The more you make, the higher the percentage of your income goes to taxes. This is the core challenge high earners face. And it's exactly why understanding your financial structure isn't a luxury anymore. It's an absolute necessity.
So, where do we even start? Well, the tax code itself actually gives us the first big clue. And it's this: not all money is treated the same. Not even close. You've got your ordinary income, from your job or your active business, and that gets taxed at a really high rate. But then you have long-term capital gains from assets you've held for a while, and those are taxed at a much lower rate. Understanding this one distinction, honestly, it's the bedrock of this entire framework.
So here's how we're going to break it all down. First, we'll dig a little deeper into that high earner tax problem. Then we'll lay out a whole new financial blueprint. After that, we'll open up the asset protection toolbox, talk about some really powerful tax reduction levers, and finally, we'll cover how to invest with all these tax advantages in mind.
Okay, section 2, a new financial blueprint. So how do you actually build this thing? Well, it all starts with a really solid foundational structure. There's a simple, but believe me, incredibly powerful way to visualize this. It's often called the T formation. Just think of it as a mental model, a way to organize your entire financial world for maximum protection and efficiency. So, let's start at the bottom of that T. What's holding it all up? It's the trust. Seriously, think of this as the anchor for your entire financial legacy. Its main job? Long-term wealth transfer and estate planning. It's all about making sure there's continuity, for generations to come. Okay, now let's look at one of the arms of the T. Over here, you've got your operational entities. These are your active businesses. They're the engines generating your main income. This is the busy side of things, where all the day-to-day transactions, the employees, the customer interactions, all of that happens right here. And then, on the other side of the T, you have the asset-holding entities. Now, these are designed for one purpose and one purpose only, to quietly and safely own your passive, income-producing assets. By keeping these assets separate from your daily operations, you totally shield them from all the risks and liabilities of the active business.
And here it is, the whole blueprint laid out. You can really see that clear separation of duties, right? Active business, the engine, on one side. Your protected, passive assets on the other. And it's all built on top of that solid trust foundation for your long-term legacy planning. It's literally a fortress built by design.
All right, so now we have the blueprint. Let's talk about the specific tools you actually use to build it. And we're gonna focus on one of the most powerful and honestly, one of the most misunderstood tax-saving strategies out there for entrepreneurs and small business owners. Okay, so for a lot of business owners, one of the biggest tax headaches is the self-employment tax. It's a flat 15.3% tax that gets slapped on every single dollar of profit your business makes. And as your income grows, man, this thing can become a really significant drain on your resources. But what if there was a way around it? Well, there is. By making a pretty simple election with the IRS for your LLC to be taxed as an S-Corporation, you get this amazing ability to strategically split your income. Here's how it works. You pay yourself a reasonable salary, and yeah, that part is subject to the 15.3% tax. But here's the key. The IRS sees that salary as payment for your labor. Then, the rest of the profit, you can take that as a profit distribution, which is seen as a return on your investment. And that part is not subject to self-employment tax.
So what does this actually mean in real dollars? Well, the savings are huge. Let's say you have $100,000 in profit. Normally, you'd pay that 15.3% tax on the whole thing. But with an S-Corp election, you might pay it on, say, just a $30,000 salary. And the tax on the other $70,000, it just vanishes. We're talking about thousands and thousands of dollars in savings, right there.
Okay, moving on. Optimizing your business entity is a massive first step, but it's not the only move you can make. There are other strategic levers you can pull to dramatically accelerate your tax benefits. And while you can use this stuff in a lot of areas, there's nowhere it's more powerful than in the world of real estate investing.
So when you own a rental property, the IRS actually lets you deduct the value of the building over time. It's called depreciation. The standard way to do this is called straight-line depreciation, which, well, it spreads that deduction out evenly over 27.5 years. It's a small, steady benefit, but man, is it slow. And that brings up a really important question for any investor, right? I mean, a tax deduction today is always worth more than a tax deduction way down the road. So the big question is there a way to front-load these powerful deductions to get a much bigger immediate impact on your tax bill right now? The answer is a big yes. And you do it through something called the cost segregation study. Basically, you get some engineers to come in and analyze the property, breaking it down into all its little components. Things like carpets, light fixtures, even the appliances. They get reclassified, and those items can be depreciated over much, much faster schedules, like 5 or 7 years. What this strategy does is it essentially pulls decades of future tax deductions into the present, and that can have a massive impact on your tax bill today.
All right, let's get to the final piece of this puzzle. This is all about aligning your investment strategy with what the tax code clearly favors. Because it's not just about what you invest in, it's about how you invest.
A really fundamental principle here is just your holding period. How long do you own an asset? If you sell something in less than a year, guess what? The profit is taxed as ordinary income at those super high rates we talked about at the beginning. But if you just hold it for more than a year, it becomes a long-term capital gain, and that changes the entire math. That 1-year mark, it's like a magic number. Holding an investment for just 1 day longer can drop the maximum federal tax rate on your profits all the way from 37% down to just 20%. In this game, patience is literally rewarded by the tax code.
And on top of that, you can use specialized accounts to supercharge your strategy. You've got your traditional 401ks and IRAs, which give you a tax break right now. Then you have Roth accounts, which are kind of the opposite. You pay tax now, but then everything grows and comes out completely tax-free later on. And then you have the Holy Grail, HSAs, health savings accounts. These things offer an incredible triple tax advantage. Your contributions are tax deductible, it grows tax-free, and your withdrawals for medical stuff are tax-free. It's amazing. So look, when you put all these pieces together, the T formation for structure, the S-Corp election, accelerated depreciation, tax-aware investing, you start to see the big picture. The core idea here is a fundamental shift in thinking. It's moving away from just earning money and toward architecting a whole financial system that's built from the ground up for efficiency and protection.
And all of this really leaves us with one final and maybe a little provocative thought. I want you to take a hard look at your own finances. Is your current setup an asset that's actively working for you, protecting and growing your wealth in the most efficient way possible? Or is it a liability? Is the lack of a smart structure passively costing you money every single year?